Hi, folks. Welcome back to our weekly market and value line portfolio review for August 23rd, 2025. This week's story is all about the Jerome Powell Pivot. He's the Fed chairman. A single speech that flipped the market from a losing week to a record close for the Dow Jones Industrial Average. That's the last rate index to make a new high. More importantly, it validated a rotation we've been talking about and acting on for the past 3 weeks. Today, I'll walk you through the market's move, our portfolio's performance, and what to watch in the weeks ahead. Through Thursday, the market was set up for another losing week. Tech stocks dragged indices lower, and the mood was risk off. Then came Powell's speech. He said plainly, this is a quote, "Downside risks to employment are rising, and that the balance of risks appears to be shifting." I kid you not, that's all he said. And the market's reaction? Immediate. The Dow surged more than 850 points, its first record close of 2025, like I said. So the Powell put is back. The Fed is signaling it will prioritize jobs over inflation, and Wall Street heard it loud and clear. This wasn't just a headline rally. It was a rotation. Capital flowed out of mega cap tech and into value, cyclicals, and interest rate sensitive stocks. Housing, travel, real estate sectors all saw inflows as investors positioned for lower borrowing costs. We've been preparing for this too. If you've been watching these weekly videos or reviews, you know we started reducing exposure to those over-owned and somewhat overvalued mega cap tech stocks. And we've been adding to some pharma names, pharmaceutical names, and some smaller capitalization opportunities like MedPace and IBD, which I'll talk about in just a moment. So let's take a look at the numbers. The S&P 500 tracked by spiders, we call them spiders. This is the S&P 500 ETF. Symbol is SPY, so it trades like a stock. And that barely eked out a 0.3% gain. The NASDAQ 100 is heavy with big tech, lost nearly 1%. But the Russell 2000 small caps surged 3.4%. Why? Well, smaller companies are more domestically focused and carry heavier debt loads. So when interest rates are set to fall, their prospects improve dramatically. And this isn't coming out of nowhere. On August 2nd, we showed how Microsoft, Nvidia, AMD, and Broadcom were still carrying the AI torch, but they warned that those valuations were stretched. And the very next week, on August 9th, we highlighted installed building products. It surged 25% and began reallocating capital, trimming mega cap tech stocks and moving some of the money into smaller capitalization, medium capitalization, and housing-related names. Then on August 16th, the next week, Warren Buffett's big United Healthcare bet spotlighted the healthcare industry. So for us, it was some pharmaceutical companies, and at the same time, the semis stumbled under their own weight of tariffs. And here we are, August 23rd, and small caps are leading decisively. That's exactly why we rotated out of Microsoft and Nvidia and Taiwan Semiconductor and Broadcom and into those pharmaceutical stocks and some other housing-related names like installed building products. Strategy's working so far, and you're seeing it unfold right here. Energy, real estate, utilities all gained more than 2%. Consumer discretionary sector surged nearly 3% on Friday alone, led by home builders and travel stocks. Meanwhile, tech and communication services sectors lagged. Hey, you notice a pattern? Sectors tied to the real economy. I don't know why we call it the real economy when all the other sectors are the real economy too. But anyway, that's the way we've been doing it for years. And the real economy is housing, energy, utilities, and they're leading now. Just 2 weeks ago, we said healthcare was breaking out thanks to Buffett's UNH bet. Now you're seeing the same shift across other rate-sensitive groups. This is the broadening of leadership we've been waiting for. Even though only 7 stocks make up 30% of the market capitalization of the S&P 500 still. So it might be broadening out, but we got a long way to go to make it a more broad rally. Enphase Energy jumped 10% on solar optimism. These are the top S&P 500 gainers, number one. Lower rates mean cheaper project financing for consumers. Mohawk Industries, the flooring company, rallied 7% on housing tailwinds and a $500 million buyback. And in travel, cruise lines and casinos, Norwegian Cruise Lines, Caesars World Casino, and Carnival Cruise Lines They all surged 6 to 7%. This isn't just a one-off bounce. It's the mirror image of what we saw on August 2nd, when the artificial intelligence names dominated. The winners were rotating, and they're coming straight from the value and cyclical side of the market. And the top losers in the S&P 500, the first one, Intuit, fell 5% on weak MailChimp demand and softer TurboTax revenue. CSX, the railroad, slipped 3.6% despite a Burlington Northern Santa Fe Railroad partnership, which was weighed down by activist pressure. Losers in the S&P were Core Labs, Workday, Kroger, the supermarket chain, also declined. Contrast this with earlier in August, when our laggers were almost exclusively big pharmaceutical companies and the luxury names. So Novo Nordisk, the Wegovy company, LVMH, which is Louis Vuitton, and Amazon. Rotation is real. Losers are shifting week to week, and they're no longer just the same culprits. In the ValueAligned Portfolio performance, we did great. Our ValueAligned Portfolio gained 1.2% this last week. It beat the S&P's 0.3% and trounces the Nasdaq's negative 0.9%. And it wasn't luck. On August 2nd, tech and artificial intelligence were driving our strength. Then on August 9th, it was IPB, Apple, and Tesla carried the torch. On August 16th, the week before this, it was Eli Lilly, NXP Semiconductors, which is a semiconductor stock that's really not related so much to AI directly, but they make chips that go into automobiles, and they make chips that go into robots and manufacturing equipment. And then there's Thermo Fisher, which is the very large distributor of laboratory equipment, both consumables and both the really high-tech equipment that makes the laboratories, both in research and in the medical field, tick. So this week, it's Novo Nordisk, Accenture, and Merck. Novo Nordisk, of course, that Wegovy company, Accenture, and Merck. And that's the power of diversification and some active positioning. We don't rely on one theme. We own great businesses across industries, so when rotations happen, we stay a step ahead. Novo Nordisk soared nearly 9% after the FDA approved Wegovy for liver disease. Keep getting expanded labels, uses for Wegovy, and they lowered the cost of Wegovy for self-paying patients. Just 3 weeks ago, Novo was our worst performer after cutting guidance, and now it's leading. That's why you hold quality, because turnarounds happen fast. Can't time them, and you never know. You just figure out which are the quality companies, which have ownership-like incentives, or which ones are monopolies or oligopolies in the field and are led by great management or great management processes. Then you hold them. You hold them for a long, long time till their intrinsic value gets ahead of its market value. Right now, Novo Nordisk, in our opinion, is undervalued by 30 to 40%. And hopefully we'll own that for a very, very long time. Accenture jumped 5%. Accenture is, it's spin-off of Anderson Accounting. It's been spun off for 20 years now. And they do IT consulting for the most part. That was up 5% after acquiring Highlands Consulting, deepening government work in California. Now, for instance, Accenture's one of 5 companies that we own, that we've owned since the beginning of the company back in 2002. So what is that, 23 years? 23 years we've owned Accenture. And when it goes down, well below intrinsic value, we buy some more. And we did recently buy some more Accenture. And Merck, the drug company located here in New Jersey, rose 3.7% with FDA breakthrough designation for a lung cancer drug. And notice the mix again. Pharmaceuticals and consulting are now leading the way. Exactly the shift we keep positioning for when we trim some tech. And the bottom performers now for the VAP, that's our portfolio, of course. Our laggers this week were all tech. AMD dropped 5.5%, but that's okay because it's definitely profit taking, because before the profit taking, it was up about 40% year to date. And that's not too shabby. Broadcom slipped 4% despite record revenue in its earnings release. Again, Broadcom is another one of the stocks that we trimmed. And the reason why we trimmed it was because it's overvalued. So when you need some capital, the place to get it from are those overvalued companies. We still own a large position in Broadcom, but we trimmed it a little bit. And then Microsoft lost 2.5%, mostly as a source of funds for the rotation. So other companies did what we did. Microsoft was way up there in valuation. And so what happened was they lowered the boom and bit the bullet, took some took some off the top, and then bought something else. Of course, this whole thing is, again, the reverse of what we saw on August 2nd when those same names were at the top of the leaderboard for the value-aligned portfolio. And we've been taking gains in those big names and rotating it towards the pharma and housing companies. You can see that the decision cushioned our blow, and actually some blow. We were up bigger than the markets this week. Economic data behind the pivot, well, here it is. The manufacturing PMI came in at 53. Let me explain. The PMI stands for Purchasing Managers Index. Manufacturing is just that. It's from companies that actually make stuff, make things, physical things. And what they do is they go and do a survey every month of those purchasing managers. The purchasing managers, of course, they're buying inputs into whatever they're making. So they have a good long look into how well business is out to the future. So we ask them how things are going. And so usually a very good idea of how things are going in the economy or how much they will be going, given some lead times. But this manufacturing PMI, contrary to what Mr. Powell said, it was stronger than expected. The services PMI at 55. Now, this is just the reverse. These are companies that are services companies like United Healthcare, for instance. So you go ask their purchasing managers and you find out what's going on there. And so if those purchasing managers are seeing higher prices or lower prices or they're hiring, they'll be able to see that in the early look at these PMIs. Services PMI was at 55, and that also beat forecasts. Last week, housing starts jumped to 1.43 million. That's good. But jobless claims ticked a little bit higher again. Just so you guys know, jobless claims is a very frequent weekly data set, and it's a good leading indicator for how well the monthly that comes at the beginning of the following month, the monthly job numbers are going to be. So it's important to measure that. If we get more tick-ups in jobless claims, it means more people are getting laid off. That cooling labor market data was the key. It gave Powell the cover to say there are risks to employment are rising. Not a big cover, mind you. There are other reasons why Powell changed his stance, but there we go. It's the same labor theme we've been tracking since the weak July jobs report that fueled the August 9th rally. Fed policy narrative. The July FOMC minutes, now FOMC stands for Federal Open Market Committee, and that's the board that sets monetary policy. Now, in the July meeting, we get that 2 or 3 weeks after the meeting, we actually get their minutes and we hear what people were saying in the meeting. And it turns out that when we got to look into that meeting, they sounded pretty hawkish, like they were not going to lower interest rates. They were focused on inflation. But Chairman Powell's Jackson Hole speech flipped the script pretty abruptly, if you ask me. He admitted the Fed has to balance inflation risk with employment risk. And he said it as though they really can do that. As you can see, I'm not a fan of the Fed. That was the strongest signal yet for a September rate cut, and the market immediately priced it in. We can get from futures markets what the market is pricing in as far as odds. They jumped from the low 70s to the low 90s as soon as he said those magic words. Washington's not helping much. New tariffs on steel and aluminum that came out are inflationary, and Powell, he acknowledged that. He said that the effects are now clearly visible. So now that he can see it, he doesn't think it's going to be so bad. Yeah? How does he know? We've been talking about this tension for weeks. Fiscal policy pushing inflation up while monetary policy prepares to ease. That conflict, by the way, is not going to go away. Globally, the U.S.-Russia summit failed to produce a Ukraine ceasefire, and that kept oil prices supported, meaning kept them up a little bit. U.S.-China tensions hit tech directly with reports that Nvidia, here's that Nvidia again, had to halt their H20 chip production for China. Then we had the IMF, which is the International Monetary Fund, warning of a steady but slow global growth amid trade fragmentation, which I'm not sure what that means. Steady but slow growth doesn't sound so bad. Oh, not a dire warning, that's for sure. They don't know what they're talking about. 3 weeks running, geopolitics have been more than background noise. They're moving specific sectors like energy and semiconductors and luxury goods like our LVMH, which is Louis Vuitton. But here's what matters next week. Upcoming is consumer confidence on Tuesday. And then on Wednesday, we have Nvidia's earnings. That's a big deal. Thursday, we have the second quarter GDP update report. There's 3 updates for quarterly GDP report. This will be the second one for the quarter. That's not so much a big deal, but Friday, we have PCE inflation. That is a big deal. And that's the personal consumption expenditure deflator, they call it. And that's the Fed's favored inflation gauge. Out of all the inflation gauges that are wrong, they like that one. So that's why it's important on Friday. We've been saying for 3 straight weeks, inflation and Nvidia are the 2 levers that are going to drive the stock market, and that still remains true. Versus bear scenarios for next week. The bullish case is that Friday's rally continues through the whole week. The PCE comes in tame, that means lower inflation. And Nvidia delivers some strong earnings, and that's fueling a broad rally. And of course, the bear case is just the opposite. PC runs hot, higher than expected inflation. Nvidia disappoints in their earnings and their guidance. And then we find out Friday was just a blow off top, meaning that we're going to tread water or go down in September. The next 5 trading days will decide which path we take. What sector should we watch? Watch financials and industrials, both signal whether the cyclical rotation still has leg. And of course, always watch technology. That's the leader. Nvidia's earnings are the linchpin. And as I said, on August 2nd, Nvidia is the cornerstone of the AI trade. And if it stumbles, the entire sector feels it. It could be this time. Every time for the last 2 or 3 months that Nvidia reports its earnings, a lot of the pundits have believed that it can't get much better. So we're going to disappoint. It hadn't happened yet. This could be, of course, this week. Will I sell it based on that? No. You don't sell it based on quarterly numbers or what some traders think the expectations should have been. Nope. We want to hold stocks for a very, very long period of time. Why do we do that, by the way? Well, if you think about it, we want to own assets in our financial practice. Why? We want to own them and own them for a very long period of time and never pay taxes on them, or at least never pay taxes on the unrealized gain portion of it. And if we're lucky, we'll have some clients that'll own these things until the day they die. And for their income, they simply take out loans. And that's the way the rich have been avoiding taxes on their wealth for years and years. And it's the reason why people in the Congress, like Elizabeth Warren, for instance, is advocating a wealth tax, because they can't get at that person's income because they just don't have any income, because they don't have any taxable income. So they want to make unrealized gains taxable. Tried it in Europe and in a few places, and it was a disaster, and they reversed. It'll be a disaster here too. Can't do it. But so they can't do it. So what happens is all these people like us that are rich, but we're in the top 10%, not the top 0.1%, like these guys, we can do the same kind of things with our assets. So that's one of the strategies that many of my clients use. Anyway, so what's the key takeaways? Key takeaways are 4 of them. Powell pivoted, so cuts are coming. Rotation's underway out of tech for the time being. I don't think we're going to have a major shutdown in tech. I just think it's going to be a slog. And that money's going into cyclicals and small caps and pharmaceuticals. Our ValueAligned portfolio outperformed again, thanks to the diversification and active positioning. And of course, next week is critical, as is all weeks, but next week is especially critical because we have an inflation gauge that is the favorite of the Fed. And we, of course, have Nvidia earnings. It is just the largest company in the world right now. And if wealth is your goal, don't chase fads. You own great businesses like we do. You stay diversified within sectors, but not within asset classes. You just own great businesses or shares of great businesses, and let the rotation out of overvalued into undervalued in the interim work in our favor, and make sure you own those businesses forever. Thanks for joining this week's ValueAligned Portfolio Review. Remember, this isn't about chasing headlines. That's not why we do this. We just want to keep you informed. And it gives us a chance to talk a little bit about our portfolio and what we're thinking. But remember, it's about owning great businesses all the time and shares of those great businesses, and then compounding wealth over time. Never, ever interrupt the compounding. And what that means is educate yourselves, and that's why we do these. Always remember and never panic, especially in the lead. Remember, anytime the market has gone down in the last 100 years, it's just a temporary interruption of what seems to be a permanent uptrend. Don't interrupt your compounding by taking permanent losses by selling because it makes you feel good. No, be rational by educating yourself, and let us take care of all those emotional sides. Let us absorb it. And then someday on the other side, you'll be looking back and saying to yourself, oh my gosh, we made so much money since the bottom. And that's what happens almost every time. It's happened in my 40-year career. And that's what I do. So we don't interrupt the compounding. So we'll be back on August 30th with the next update. Stay the course, and I'll see you then. Bye-bye.